Hello everyone, and thank you for joining us for today's Climate Bonds webinar on primary market pricing. Caroline Harrison, Senior Research Analyst, and Manuel Adamini, Director of Investor Outreach and Partners Programme, are here today to talk you through this webinar. Before we begin, I'd just like to go over some basic housekeeping. This webinar will run for 1 hour. We will have a dedicated Q&A session at the end of the presentation. You can submit questions at any point during the webinar by using the Q&A panel at the top right-hand corner in the webinar platform. If you're phoning in, you can also submit questions by emailing them to katie@climatebonds.net. This webinar is being recorded and will be made publicly available to participants and on our YouTube channel shortly. Now, over to Manuel to kick us off. Manuel, are you having problems with your audio? We can't hear you at the moment.
Yes, can you hear me now?
Yes, that's loud and clear.
Oh, so apologies for that. Thanks for making the introduction, Katie. And indeed, I was saying that I assumed everyone could hear me okay. If there's any problems, you can drop the questions as presented on the sheet here now and raise your hand. So before we start, let me express some gratitude to a couple of people. I mean, first of all, thanks to Katie for helping us with the logistics and making sure the IT works and reminding me of how to use my mic indeed. Then Caroline, thank you so much for conducting the study as such, and that's good for you as an audience. You will have the unique opportunity to hear firsthand from the person that conducted the study. In order to make all of that possible, indeed, we are grateful to our sponsors, Oppian, Rabobank, Pax World Mutual Funds, and the RFC, who have also contributed to this study by introducing us to very important reviewers and many people in the marketplace we could use to bounce first ideas and have draft outcomes reviews, as clearly this is a sensitive issue that we wanted to research very, very well. You know, it's also a topical issue. As you may have noted, the Financial Times has, as recently as last week, devoted some flagship articles to the issue of primary market pricing. So, without further ado, let me start here. Essentially, we have a webinar split in 2 sections today, a very brief overview into whose Climate Bonds Initiative. For those who don't know us, it may be worthwhile to know. For those who do know us, it will be short enough not to bore you. Then a very quick glance at what the market looks like, just as an overview to understand the space we're operating in and that we have researched with this very study. And then I will hand over to Caroline to talk us through pricing in detail, and there will be ample of opportunity for the audience to raise questions. So the Climate Bonds Initiative is a registered UK charity, an investor-focused not-for-profit with a mission to mobilize debt capital markets to find climate solutions. And indeed, this mobilization is probably what we're most well known for, and we've been around since almost 10 years, not so long after the ERB and the World Bank had essentially founded the market by bringing the product to the market. But, you know, if you want to bring people together and you make them enthusiastic about the market, it's obviously also very important to inform them well. Their questions become more detailed and more nuanced. Hence, we provide a lot of information to the market. What we're talking about today is a very specific type of research. If you visit our website, you will see there's many, many studies out there, thematic or regionally focused, and we're definitely well known for the Global State of the Market report funded by HSBC, which we've done for the 6th time this year already. Once the market grows, it's also very important to protect its integrity. As more and more issuers come to the market, It's important we make sure that what investors pay for as green actually is green. And hence we have introduced something akin to a fair trade logo, if you will, to make sure that when it says green on the tin, there's actually green inside. That's the Climate Bond Standards and Certification Scheme, and we are seeing a flurry of certified deals recently. That's very encouraging. Finally, we're working with our partners to further activate this market. We're working with all these various partners you see on this sheet, on the buy side, on the sell side, intermediaries. All of them have their role to play, and we're working together at the intersection of our mission and their business to further advance this market. On the next slide, you will see some of the benefits that our partners enjoy. Again, essentially, it's two brands coming together, our brand as a mobilizer of the market and the partners brand, whether on the buy side or sell side or elsewhere in the space, working around areas of common interest. One immediate benefit people get from our partnership is access to data about the labeled green bonds market that is accessible for our partners through our website, and you just get a brief glance of what it's all about here. If you're further interested, please do feel free to reach out to me. Well, so that was a brief introduction of who we are. What's the space we're working in? Well, here's some high-level figures, some brief overview about the state of the market. Again, the details you can see in that same study, State of the Market report, that you can immediately find on our website. I mean, let's not forget, before we talk price, which evidently is a very important aspect of that market, whether or not any price differentials in that market emerge to the benefit of the issuers or the investors. That's what we're going to hear today, but that's something that emerges in a more mature market. We are building a market here, and that's the thing I wanted to remind everyone of is when we started the market in 2013, that was on the back of development banks bringing the product to market. Later we had some courageous corporates, Toyota, GDF Suez, now called MG, and Électricité de France, EDF, copying that product in the corporate space, and after the banks coming and evidently using their important leverage, their balance sheets to further grow the market. After that, last year we saw also sovereigns coming to the space, which is very important, as that's a very important, as I say, allocation pocket with the investors that buy this product. You've seen that 2 weeks ago when COP, the big climate conference in Bonn, was going on, we hit the 100 billion mark. It's a very important symbolic figure of new issuance this year, and that's just a great growth story compared to a few years ago. We're projected to reach 130 billion, maybe more till year end. But there should be more out there. There's still unserved investor demand. We've seen various climate pledges over the last few years of investors either asking for general climate-relevant investment opportunities, or more specifically for climate-relevant investment opportunities in the fixed income space and green bonds, even more specifically so. And on the back of that still largely unserved investor demand, we should be able to scale up as fast as we would need to. We don't have time to rest on our laurels, as even the Pope has told us. We have to grow this market very fast to make the rivers of capital, as Christiane Figueres, the former head of the UNFCCC, said, to make those rivers of capital flow to the right green assets and projects. The labeled green bond market, now the outstanding figure is closer to 300 billion or so. It grows so fast, the sheet is outdated every day. That's what everyone's talking about. Even if you take into account the unlabeled green bond market, which is essentially climate relevant bonds, but nobody has said so, nobody has labeled them as green bonds. That's a slightly bigger figure, but just look at this huge 90 trillion global bond market out there that we still have to bring into the climate relevant arena. So much work to be done. So let's see how pricing feeds into that. One remark before I hand over to Caroline is, although we will discuss pricing in detail, let's not forget there's more than pricing out there. There's more benefits out there, then a price advantage for maybe the issuer, maybe the investor. On the issuer side, we hear very strong anecdotal evidence from dozens, if not hundreds, of treasurers out there being very, very satisfied with their green bonds on numerous accounts, even if there wasn't a pricing benefit. They're saying they have greened their books, they have hugely internationalized their books. Go to the website of Berlin Hüb, for example. In their annual report, they're saying that on the back of the green bonds, they have hugely internationalized their books. They have attracted more than 25 new investors to their books they've never seen before. It used to be a typical German name, typically funded by German institutional investors alone. Now they went international big time. Same KfW, they've said in public that they have attracted more than 50 new investors on the back of the green bond they had never seen before. These are typically things that also make a CFO office and a CFO himself very happy, apart from a pricing benefit that may or may not be there. We also hear that those investors that buy green buy because they want the green and because there's still somewhat limited supply in the market, they will stick to it. So they tend to sit on it. That means a stable book going forward, again, a benefit to the issuer, albeit not an immediate pecuniary one. Also, we hear that it's very important from a marketing and communications perspective to align the wider corporate social responsibility profile and the sustainability-oriented core business propositions, not only with your own pension fund investment as a corporate, but also with your very funding. So aligning both sides of the balance sheet with the sustainability drive into your core business. We hear many treasurers saying that that employee pride and employee retention have grown dramatically on the back of green bonds. So these are all, albeit slightly less tangible benefits to a green bond apart from pricing. On the investor side, clearly we're seeing that many investors want to have access to green products, not only as it may have traditionally been biased on the equity side, but also on the fixed income side, and they want to have that access to green through well-understood products. And you know, a green bond is nothing but an ordinary bond, except that the issuer tells people where the money will go, to green. Clearly, in some jurisdictions, led by France, there's also a drive to have green assets on your books as an investor, and green bonds can be a very good means to achieve that access to green on the fixed income side. We will also talk about secondary market performance, and Caroline will show us how strong that has been in many instances. Finally, as I used to head one of the responsible investment departments at a Dutch asset manager myself, I can tell you on the equity side, one has long talked about engagement with corporate boards, but I must admit I've never found that particularly fruitful until green bonds entered the fore. I've never had such positive and such effective discussions with senior company management, including boards, as I had on the back of green bonds at the time. So that's also a very important benefit for investors. Thank you very much for having the pleasure to make this brief introduction. Let's now, without further ado, hand over to Caroline to talk us through this study in much more detail. Thank you very much.
Thank you, Manuel. Sorry about the delay. And thank you also, Katie, for your earlier introduction. I just want to reiterate one of the points that Manuel touched upon, which is one of the benefits of the partner program that we offer is that partners from time to time get the opportunity to sponsor our individual work streams. This pricing work in particular was made possible through the patronage of PAX, Obvian, Rabobank, and also the IFC. But one thing that I want to take great pains to emphasise is the independence of the work. Ultimately, all the research that we do is independent. and documents that we produce are reviewed by a wide spectrum of seasoned industry participants, so before we publish, and we give equal consideration to all and any input that we receive. We are, however, a climate bonds advocacy agency. Our agenda is unapologetic in that we want to provide reasons to both issue and buy bonds to help fund the transition to a low carbon economy. We hope that this research will give issuers and buyers of green bonds credible reasons to get involved in the market. So the first thing that I want to talk about in relevance to the slide that we can see in front of us is how we have selected our universe. We've chosen for the purposes of this study only labelled green bonds. We focused our work so far on US dollar and euro denominated bonds, since those are the currencies where there's a critical mass of issuance. Anyway, during the second quarter of 2017, 101 green bonds were issued, labelled green bonds I mean, with a total size of 30 billion, and this paper captures 14 billion, so almost half of that, and includes 19 bonds, 10 of which are euro denominated and 9 of which are dollar denominated. The only other currency that has a critical mass of bonds being issued is the Chinese renminbi. So in the second quarter of this year, there were the equivalent to US dollar 6.5 billion of bonds. We are separately exploring the possibility of doing a pricing study on the renminbi green bond market, but the availability of data at this moment has prevented us from doing that. However, that is something that we are exploring, so perhaps in the future we may be able to do a publication to this one. The other thing I want to touch upon in terms of the criteria for inclusion in our study is the minimum size for inclusion. So we set the cutoff at 300 million US dollars. We did not go to full benchmark size of 500 million because that would have excluded some of the dollars denominated bonds. Particularly, I think for this publication, that would have excluded QBE Insurance, which was about 300 million, and rural electrification, which was 450 million. So we settled on a minimum of 300. In general, green bonds can sometimes be smaller than vanilla bonds, partly because in order to be a labelled green bond, the use of proceeds has to be very clearly identifiable, and the money can only be used for those specific projects. So the indicators that we have chosen once we've determined our sample size, we then decided which indicators we're going to look at, and we've chosen those based on what is most relevant to the primary market, and we've also touched upon some of the most widely discussed indicators as well. So this slide looks at where bonds price versus the initial price talk, and this is a topic that we have noticed receives a lot of airtime in the green bond space, and that's why we did in particular this metric. So whenever you read a deal summary or a price report, where the bond price versus initial price talk is always something that is talked about. Just to briefly summarise, the initial price talk is the price where a bond will be pitched at the beginning of the pricing process. The difference between the initial price talk and the final price can be influenced by a number of factors, including macro factors, such as other supply that is coming out in that week, for example, what else is available, what rates are doing, where the bond is issued, at which point in the month the bond is issued, and then there are obviously details that are bond specific, such as the credit rating of the bond, the sector, the currency, whether the issue already has debt outstanding, and all in all, this is a general process of discovery. So typically, syndicate desks don't expect bonds to price in the corporate space, at least, at the same level as where the initial price talk is. So there is some room for contraction in that price. So there is a lot of variation by sector. As I've already said, corporate bond initial price talk is a number that is expressed as a spread and will always be wider than where the new issue desk believes that the bond will finally price, whereas for quasi-governments, the IPT is much closer to the landing price. Sometimes it can be within 1 or 2 basis points in euros or 3 to 5 in dollars where the spread is slightly wider. We've compared each green bond to a bucket of bonds to see whether there are any differences between green bonds and vanilla bonds in terms of the difference between initial price talk and landing price. The baskets that we've chosen comprise of vanilla bonds which share the same currency, the same sector and the same credit rating. All the bonds that are in the basket were issued during the same quarter as the green subject bond, although not issued on the same day. In any case, this comparison allows us to look at green bonds versus their peers, just to make that comparison. We haven't added a maturity dimension to this because we felt that that would have been too restrictive, and the basket numbers that we've used are straight averages. So then, going back to the results, you can see that all bonds in our sample priced tighter than their initial price thought, which is what we would have expected. Taking a closer look at the results, among the euro bonds, we can see that 2 green bonds had a bigger difference than their vanilla basket, whereas for the dollar bonds, 6 out of 9 of the green bonds had a bigger difference than the vanilla basket. This is a process that is considered very much on a bond-by-bond basis, and green bonds don't behave any differently than vanilla bonds in that respect. The bonds that had the biggest differences between their initial price talk and their landing prices, at least among our sample, particularly among the dollar bonds, were the ones that hadn't come to the market before, such as CMPC and rural electrification. Overall, in the longer study that we published earlier this year that covered 2016 and Q1 of 2017, the dollar-denominated green bonds on average 15.3 basis points tighter than their IPT, and for Q2 that number was 15.4 basis points. So we can say that 15 basis points appears to be a normal difference between initial price talk and landing price for a US dollar-denominated green bond. For euro green bonds in the last study, it was 11.2 basis points tighter than IPT compared to just 6.3 basis points tighter for Q2. But for euro, the market has also tightened in general. So the vanilla basket, or what we used to determine the market for the longer study, has also tightened. So for 2016 to Q1 17, the market was 12 to 14 basis points tighter. But for euro-denominated bonds in Q2 of this year, it was only 9 basis points tighter. So overall, there's been a narrowing of that gap too. In other words, green bonds perform very similarly to the market in this regard. And just to emphasise that the magnitude of the tightening does vary on a bond-by-bond basis. Investor appetite for new bonds can be influenced by lots of factors that we've already touched on, such as size, the timing, the credit quality, and all the rest of it. And all these will have an effect on the speed and the size of the order book. How many times covered was the order book? And this depends on how many people really want to be involved or think that they want to be involved in the deal when the deal is at a particular price. As the price changes, the number of participants might also change. Some might drop off. But one of the main things that is going to influence the order book is who has money to put to work and what else is coming to the market in that week. Naturally, buyers tend to ask for more than what they want, so they will submit orders that are greater in size than what they expect to be delivered on, knowing that they probably won't get a full allocation. Order books were very similar overall for both green bonds and vanilla bonds. Most bonds appear to be oversubscribed in both the vanilla market and the green bond market in that respect is absolutely no different. This is a completely normal feature of the bond market. We note that dollar bonds in general are more oversubscribed than euro bonds. And again, that is the same for both the market and the individual green bonds. We conclude that the subscription levels for green bonds are similar or no different from what they are for vanilla bonds. So overall, according to this metric, green bonds behave broadly in line with the market and as we would expect in the current economic climate. So this slide is a visual representation of how bonds are allocated to green investors versus just normal investors, or at least investors that don't declare themselves to be green. So in order to gather this data, we contacted individually the issuers of the green bonds in the second quarter of this year and asked them what percentage of their issue ended up with a declared green investor versus an investor that had not declared green investment mandate. That declaration doesn't necessarily tell us everything, but we don't know what we don't know. So we base this data only on the information that we had rather than what we could read into it. Treasurers say often that issuing green bonds can give them access to a broader investor base. Manuel's already spoken about this, and book runners will say that the green angle can result in tighter pricing. So that's why we've decided to look into this more closely. So of the 19 issuers that we contacted, we can see that green bonds receive support from all areas of the market, which means that for many investors, they appear to be interchangeable with non-green bonds. 62% of the developed market green bonds were allocated to dedicated green bond investors, and that figure was slightly lower at 25% for those of emerging market domicile, which is the three that you can see to the right hand of the graph. Market participants have told us that 15 to 30% of an emerging market bond going to green investors is probably about normal. And we understand that developed market bonds were getting that sort of interest a few years ago. And nowadays, the expectation is for about 40% of a developed market domicile green bond to go to a green bond investor. But we see for our sample that the minimum was 45%. So kind of exceed, the evidence exceeds what is in fact suggested. So we suspect the most likely explanation for this is that there's been an increase in the number of green bond funds over the last couple of years. And in addition to the funds that are labelling themselves as green, there are other investors who are categorised as being light green, or who may have a green bias, but which may not be stated explicitly. So this is an area of work that is of great interest to us and that we will continue to monitor going forward, and also try to expand perhaps by exploring the number of the green funds that are out there and the growth in those funds. Okay, so a lot of questions that we get are to do with whether or not there is a new issue premium or a new issue discount for green bonds. We have termed the new issue discount the Greenium, and that is the critical element of the pricing puzzle that tells us whether a bond comes rich or cheap versus its existing debt. Existing debt in most cases tends to comprise of vanilla bonds. So doing this analysis obviously has a couple of challenges, which I'm just briefly going to touch upon. The number one challenge being that not all bonds have comparable peers in the market. So that is something that excludes some of the bonds in our sample from being included in this particular area of analysis. This data also relies on bond prices being updated. Some of them could be stale, although we have only chosen peers that are issued after 2010. 7 years can be quite a long time. in terms of liquidity in the bond space. Thirdly, there's no standard for measuring a new issue discount or a new issue premium per se, or at least that we're aware of. And that is why in the research paper that we've written, we've gone to great pains to describe exactly what data points we've used and exactly how we've calculated the data, because we just want to be very clear about what we've done. And again, we're aware that just using one data point, using slightly different data, will give a different result, which could obviously influence the outcome. Overall, there's nothing conclusive to the bonds that we've seen, in fact. Sometimes they price inside their curves, sometimes they price on their curves, and sometimes they price outside their curves. And this is normal market behaviour. This is no different for green bonds than it is for non-green bonds. So you can see that I'm picking out a bit of a theme here with this story, but this is what we've seen. From the data that we have, we can't say that a green bond will definitely come with a premium or will definitely come with a greenium, i.e. a discount. Again, this is an area where we'd like to do a lot more work on new issue premiums or discounts. There hasn't been a lot of evidence to suggest that green bonds receive discounts at primary because they're green. So making that connection has been something that we haven't been able to do. But we know that green bonds are price tighter in the secondary market. It's something that's been well documented, not only by us, but by others that have done research into this area. So with this in mind, we wonder whether as issuers start to build out green bond curves, new green bonds will then price off those curves. And perhaps we will then see some differentiation between green and vanilla pricing, although we wonder that when green bond issuers have a full curve, whether they will still be issuing non-green bonds and whether the relative newness of the green bonds will influence that perceived difference in pricing. So while we have seen some instances of greenium, as yet there is no consistent pattern. So we've looked at how bonds behave in the immediate secondary market. As I've said, we are aware of others that have done more longitudinal studies into the behaviour of green bonds in the secondary market, and we just want to see how they behave in the first month. We believe that in this case the pricing is a bit fresher and perhaps can give a clearer indication of actual activity in the market. So we know that new issues, the bond issues, green or vanilla, tend to tighten on the break, and we know that this normal market behaviour extends to green bonds as well. So for our first publication, which covered all of 2016 and Q1 of 2017, we noted that 70% of green bonds had tighter spreads after 7 days, and 63% of green bonds had tighter spreads after 28 days. In the second publication, which is the one that we are talking about here, 75% of green bonds in both dollars and euros had tighter spreads after 7 and 28 days. We have added for this publication the dimension of comparison. So we've compared each green bond to a basket, and those baskets are constructed in the way that I described earlier. 40% of green bonds had larger movements in their baskets after 7 days, and after 28 days that figure was 35%. So we note in particular that the 5 euro-denominated corporate issuers all tightened materially both 7 days and 28 days after announcement, and as such more so than their baskets. A driver of this could be a desire for the diversity. Up until now, there hasn't been a lot of diversity in the corporate issue and in the corporate issuance of green bonds in euros, and that's something that we're hoping will increase. But this pricing data suggests, if you like, that investors like particularly corporate green bonds. We understand that the secondary market for green bonds is not particularly active, but within those, within that constraint, this is what we're seeing. Among the dollar bonds that did better than their baskets in secondary, EIB is an example of a long-established green bond issuer, and the fact that in this instance they issued in a 10-year tenor, that may have helped the bond perform better in the secondary market. The Apple bond did do better than its basket, and by the way, the basket of comparable bonds that we used included 4 other Apple bonds that we issued a month prior. So this kind of supports the work that we did in our prior publication, which suggested that a green Apple bond issued on the same day as vanilla Apple bonds actually tended to perform slightly better. Although in this case it's a bit more difficult to make that direct comparison because the bonds were not issued on the same day, and it's important to emphasise that. So overall, what we can take away from this is that all the bonds in our Euro corporate credit sample, the green bonds at least, tightened in excess of their basket. So one of the things that we wanted to do was to look at how green bonds performed against indices. So indices indicate an alternative way. It's an alternative way for us to look at bonds in the immediate secondary market, and it's looking at how new issues perform against seasoned bonds and the seasoned basket of bonds. So for our current publication, we can see that 66% of green bonds tighten more than their indices in the secondary market after 7 days. And the magnitude of that tightening was quite large. After 28 days, that had diminished, if you like, to 53%. So the numbers in general were lower for the dollar-denominated instruments, but there is an interest rate differential and also some political issues in the US that may not favour investors embracing risk that comes with corporate investment over that period. For the 2016 and Q1 2017 publication, 70% of bonds tightened after 7 days and 71% were tightened after 28 days. Again, Euro bonds did better than dollars on the whole when compared to indices. And what we can say about the difference between the euros and the dollars, apart from the interest rates and the political considerations, is that a lot of green investors are running euro-denominated portfolios. So perhaps, although we really don't know, but perhaps that is a contributory factor. So all issuers mentioned that they felt there were benefits associated with issuing green bonds. And again, this is something that Manuel spoke about earlier. Introducing new investors into deals because they are green and broadening the geographic diversity of the investor base is something that all treasurers really, really liked. A diverse investor base could offer stability in times of volatility. One of the many areas we would like to do more work on is to explore how green bonds perform during risk-off periods. In fact, we suspect that green bonds tend to remain relatively stable in periods of low risk appetite, but we would like to verify that with some evidence-based work. There are other reasons to issue green bonds beyond the perceived pricing benefits. Issuing a green bond will definitely confirm to an investor that there is an institutional commitment to investing in climate change solutions, and if you like, it reiterates the environmental responsibility, the transparency, the accountability across all aspects of the project, and investors tend to take comfort from that additional degree of transparency, which we hope would impact all areas of the business. So that concludes my summary of the analysis. obviously, I'm going to hand back to Manuel now, I think, and we're going to manage some questions.
Yeah, I'll actually take over, Caroline. But thanks very much to Manuel and Caroline for that introduction. And we'll now open up for a Q&A. Just as a reminder, the top right-hand corner of your box, there's a Q&A tab. You can submit your questions there. We've already had a few coming in. So just as a first one to kick us off, what do you think is going to happen with this pricing in the future? How do you see that evolving?
Okay, well, from the supply side, we hope that an increasing number of green bonds will come to the market. And at the same time, we hope that an increasing number of investors will embrace the importance of preferencing green bonds. As I mentioned in the discussion, repeat issuers will eventually build out green bond curves, which at the moment tend to sit inside vanilla bond curves. So in theory, there could be some price advantage to those issuers who repeatedly link their debt to finance their debt to financing climate change mitigation and adaptation strategies. So over the long term, we see that there may be some financial benefit to those issuers. But that remains to be borne out, and it's something that we will follow more closely. In the medium to long term, we hope that climate change mitigation and adaptation will become a sort of integrated consideration in all business models. All infrastructure will have to be climate compatible, and so all bonds will in some way be green bonds. Once that happens, it will be a question of either sort of, okay, now all bonds are offering this benefit, so this is no longer an issue, or maybe investors will have models that will determine the degree of their contribution or the speed of the impact on something or something that we haven't thought of yet.
Thanks, Caroline. Next question. Would you say that Greenium shows up in the secondary market and that issuers and bookmakers might not be so successful or willing to capture the Greenium on the primary market?
Interesting. Okay. In terms of capturing the Greenium on the primary market, hopefully the small amount of research that we have done demonstrates that there isn't really anything to necessarily capture at the moment. I mean, we would be interested in looking at different ways of measuring that, and if people had suggestions to do that, then we would be interested in having a more sort of one-on-one discussion on that. I think book runners were fairly transparent about that type of thing, and I think we have no clear agenda to not be open and honest about anything that we find that suggests that there is a Greenium in the primary market. I mean, overall, there really isn't. Considering that green bonds have the same payment ranking as non-green bonds, there really is no reason, no material reason why an investor would be willing to pay more for a green bond. In the event that the company goes bankrupt, if I own a green bond or I own a non-green bond, as long as the payment ranking is the same, then I will be considered equally in terms of the winding up process.
Caroline? Next question. With respect to discounts to green bonds, have you had an opportunity to analyse other reports, such as the BIS quarterly report, which found that green bond issuers on average have borrowed at lower spreads than vanilla bonds?
I did read that report, and I did have some slight reservations about the methodology, not to suggest that it hadn't been conducted thoroughly, but more that the methodology had not been clearly stated in the report. So I would need to have more information before I was able to make a judgment about that, I think. We have read other reports, but I haven't seen, apart from the BIS review, I haven't seen anything else that pointed to a clear and consistent greenium across the market.
Great. Okay, next question. Sorry, I'll just read that. Okay, so the next question we've got, is there a pricing benefit to listing a bond on a green exchange?
Well, this is something that we haven't really looked at yet. We think that about 25% of green bonds are listed on exchanges. And I do know that if bonds are on green exchanges, they need to comply with a fairly strict set of criteria in order to qualify. So that in itself would lend an additional degree of integrity to bonds, signalling to investors that issuers are fulfilling robust requirements in terms of disclosure and in terms of reporting, which, as we've already said, investors tend to like. We haven't compared listed bonds with non-listed bonds, but we could definitely note in the scope of our next publication which bonds are listed and which bonds are not, just to see whether there were any differences.
Thank you. And then the next question we've got coming in, taking into consideration the benefits of green bonds for investors, do you think the expensiveness of green bonds in the secondary market is justified, or a distortion from lack of supply that should fade away with more issuers coming into the market?
Well, I think it's the market that determines how cheap or expensive a bond is in the secondary market. So that is driven purely by supply and demand. I would say one thing, which is the quality of the data. As far as I'm aware, there isn't a very liquid secondary market for green bonds, which makes it very hard to accurately price where they are or where they would trade. So that's something that I would just caution to be aware of.
Okay, thanks. Next question coming through. Is there any feedback from some of the largest global green bond underwriters as to their expectations regarding new issue discounts and or secondary trading spreads going forward, as well as their discussions with their clients?
Of course, all issuers would like to receive a discount in the primary market, and as with most of the things that we touched on in the scope of this presentation, green bonds do not differ from vanilla bonds in that respect. Everybody would like to issue cheap in the primary market, of course. But I think the where we want to put the emphasis on the benefits for green bond issuers is more of a sort of a holistic benefit in terms of diversification of the investor base due to more interest coming from perhaps a broader geographic range of investors being attracted by the green label, and then from the perspective of the investor, the benefits of the increased transparency and disclosure.
Thanks, Caroline. Were the results from the pricing study as you expected, or were any of these surprise results?
I didn't really know what to expect until well, I didn't really know what to expect. None of it really came as a particular surprise. I guess I was quite. I hadn't maybe expected the magnitude of difference in performance between bonds and indices in the secondary market. So for some of the green bonds, they appear to tighten quite significantly on the break, and yeah, I guess the magnitude of that tightening did come as a bit of a surprise. But on the whole, I didn't really know what to expect.
Any thoughts on why, given that green bonds attract a new set of investors in addition to prior or traditional investors, oversubscription at initial pricing is at the same levels as the vanilla bonds?
I I think there are some vanilla investors that will stay away from green bonds because they suspect, wrongly so, as we've demonstrated, that green bonds price tighter than vanilla bonds in primary. So that could be one deterrent. I think overall, the smaller size may be not attractive to some investors, but I think that's something that a primary market professional would need to answer.
How does the compliance cost, e.g. third-party certification, traceability of issuance proceeds, etc., influence the pricing of green bonds as compared to normal bonds?
Well, we don't believe that that should influence the pricing. The pricing for the certification and the additional costs associated with disclosure tend to be extremely negligible anyway, and those are outweighed, we believe, by the goodwill created, if you like, by that in terms of the investor diversification and perhaps attracting new areas of investment.
And on a related note, are there pricing benefits to certifying bonds?
So bonds that comply with climate bond standards are certified as climate bonds. So that label guarantees their contribution to the ambition of a low carbon economy. Just to briefly summarise, to receive our stamp of approval, an issuer must appoint an approved third-party verifier, tongue twister, who supplies an assurance report that bonds meet climate bond standards environmental requirements. So that is then given final confirmation by the Climate Bond Standards Board. So far, I think that we as an organisation have certified about 70 bonds, but in a variety of currencies and sizes. At the moment, for this pricing research, we are only looking at dollar and euro denominated bonds of a certain minimum size, which, although 300 million may seem small in terms of institutional investor sizes, a lot of the bonds that we've certified have been a good deal smaller than that. So there aren't really enough qualifying bonds that have been certified to split them out on that basis. However, our certification program has gained a lot of momentum this year, so we could consider it in the future. Anecdotally, I know that the China 3 Gorge bond was certified, and as you've seen from the presentation that I just made, or as you'll know from reading the publication, that is a bond that happened to perform particularly well in the immediate secondary market on a 7 and 28-day basis versus both basket and indices. We also mentioned separately in the publication the Obvium bond, which was issued by one of our sponsors. That was certified, and that also attracted a lot of demand in both primary and secondary markets.
Thanks, Caroline. Another question coming in, and I think this will probably have to be the last question as we're getting quite tight on time. Do investors ask for regular updates of loans projects from the green proceeds?
Yes, I think investors do ask for that, and in response to that interest from the investment community, we began this year to publish a summary of that transparency and how green bond issuers were doing on that basis. So sort of like a mark to market for those that have issued green bonds so far, who has provided the disclosure that they said they were going to provide when they issued the bonds. And in fact, that publication is available on our website.
Thanks, Caroline. So that brings us to the end of this webinar. Many thanks to all for attending, and thank you again to Manuel and Caroline for the introductory to primary market pricing. Reports are available on our website, so if you want to see further detail, have a look there. We'll also be posting a recording of this webinar online, and we'll email around the link. If you know anyone that would be interested but couldn't attend today, then please do share it. We have a second climate bonds webinar later this week, Green Bonds for Cities, a case study on Cape Town. It's going to be held on Thursday at 1 p.m. GMT. If you're interested, then registration links can be found on the Climate Bonds blog. Thanks again for attending, and hope to have you on another webinar soon.